Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 319 on April the 19th, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on the ProShares Ultra Bloomberg Natural Gas ETF, United Airlines, and Lyft Inc. And we discuss three new trades on Aurora Cannabis, the United States Oil Fund ETF, and Paramount Global. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, I get emails all the time from people asking me how I find option trades. I give them the same response every time. It's a mix of technical analysis and option trading. When these two present an opportunity that makes sense for my portfolio, I take the trade. I don't talk about technical analysis much on this podcast, but it plays a large role in my analysis. So I'd like to invite each of you to a technical analysis workshop that will happen on Saturday, May the 4th, from 1 p.m. until 4 p.m. Central Time. I plan to cover my favorite three indicators and share a few secrets that will improve the results of your technical analysis significantly. I'll also take time for a Q&A, a question and answer session at the end. The workshop will be recorded, so even if the timing does not work or make sense for you, some of my listeners live across the seas, New Zealand, India, even Russia. Even if the timing does not work, you will have access to the videos to watch and rewatch at another time. So feel free to send me an email if you are interested, and I plan to share the announcement by email with those of you who I've spoken with in the past. The markets finished with mixed results this week. The Dow Jones Industrial Average finished the week 3 points up, closing at 37,986 points on Friday. The S&P 500 index lost 156 points, ending the week at 4,967 points. And now it's time for the topic of the week. The topic of the week is preserving your capital. The topic is directly connected to risk management. It is important as a trader to preserve your capital. When you are winning, you'll be tempted to take even larger trades. When you're losing, and this can happen to even the best traders during seasons, you'll be tempted to keep trading even when you should take a break. One of the things I remind myself is that there'll be great trading opportunities tomorrow and the next day and the day after that. I must preserve my capital so that I can have the funds to trade those great opportunities to come. If you're the type to go all in, you're simply gambling. If you don't take risk management into account in your trading, you also are gambling. You must trade in a way that lets you trade another day. Oftentimes, there are equivalent products that will allow you to trade a small amount of capital and get your legs back underneath you. For instance, if you'd like to trade the daily SPX, you can trade the daily SPY, the ETF, instead. It's a smaller equivalent of the same index. Work on perfecting your strategy with a smaller account or with smaller risk, then return to the larger index when you're confident again and have more capital. Again, live to trade another day by preserving your capital. So that's it for this week's topic of the week. Let's go ahead and get into the trading review from last week's trades. We'll start off with the covered call on the ProShares Ultra Bloomberg Natural Gas ETF, symbol B as in Bravo, O as in Oscar, I as in India, L as in Lima. At the time, the stock was trading for $14.02 per share. I looked at buying stock and selling the May 15 call at $1.04, hoping for a return of 14.41% in 5 weeks. Well, shares of the Boyle ETF lost 48 cents, ending the week at $13.54 per share. The call option we sold lost 27 cents, leaving us with a net loss of 21 cents on the week. Now, we can certainly roll the strike on the option lower down to the 14 strike to take in another $1.04 per share. That would cover our initial loss and leave us with a possible upside of another 46 cents per share. That would also change our total upside to $1.29 if the stock expires above $14 per share. Our initial expected return was $2.02 per share. So this would lower our expected return significantly below the 10% mark of our cash outlay. So I don't like that part at all. We still have 4 weeks until expiration on May 17th, and the stock price is still above our break-even point on our initial trade. So if you expect the stock to head lower, it's not a bad thing to roll the strike lower at all. However, given so much time, I'd like to see if this stock is going to creep back up to $14 before graduation. Notice that I said $14 and not $15. A $15 stock price would be great, but I'm also happy if the stock holds its value from where I bought it and the option expires worthless. That will let me keep the stock and sell another option against that same stock next month, which is ultimately going to increase my overall return. So I'll attempt to be patient on this one, at least for another week. I'm happy to roll the strike lower if prices continue to slip. Next up, we had our credit spread on United Airlines, symbol U as in uniform, A as in alpha, L as in Lima. At the time, the stock was trading for $41.80 per share. I looked at selling the May 39 put spread at 33 cents, which could give us a maximum possible loss of 67 cents per spread. Now, shares of United Airlines jumped $9.58 per share, ending the week at $51.38 per share. The out-of-the-money put spread is significantly out of the money at this point. The airline stock jumped after they announced earnings a couple days ago. Now, I'm always happy to make money on a trade, but this is one of those times where I wish I'd held a deep call spread on that or owned the stock itself. With stock this high, the put spread is likely going to expire worthless, allowing us to keep the premium that we collected when we sold it. Now, you can also decide to close the spread by paying 2 or 3 cents. I'm actually a fan of milking every ounce of profit out of the trades, but sometimes it's just a good idea to take the money off the table and focus on your other trades. This one definitely worked out, so no adjustments are needed at this point. Just a question of whether or not you have an interest in closing that trade early or not. Finally, we had our debit spread on Lyft Inc., symbol L as in Lima, Y as in Yankee, F as in Foxtrot, T as in Tango. At the time, the stock was trading for $18.76 per share. I looked at buying the May 17-18 call spread for 59 cents, which could give us a maximum gain of 41 cents, or that's a 69.49% return in 5 weeks. Well, shares of Lyft lost $2.61, ending the week at $16.15 per share. That in-the-money call spread that we bought is now out of the money. Now, since we are well below our break-even point of $17.59, we can certainly make an adjustment. We can turn this debit spread into a credit spread by selling the May 17-19 call spread at 57 cents. That will allow us to regain the 28 cents we lost on the initial spread this week. However, make sure you understand the risk that you'll be entering if you make this adjustment. We still have 4 weeks left until expiration. Also, Lyft is going to announce earnings on May the 7th, 10 days prior to expiration. So if there's any reason to wait before adjusting this trade, it's the possibility of a stock price jump after earnings. Feel free to take some time to research the earnings expectations if you'd like. Also, look at how the stock has performed in the past to get a sense of what is possible with a good or bad earnings announcement. We are in earnings season, so make sure that you keep that in mind for all of your trades. All right, that's it for the trade review from last week. We're going to get into the new trades this week. Definitely want to point out that today, Friday, April the 19th, was options expiration for all monthly options in April. The trades on today's show all will use the May 17th expiration date for monthly options in May. And I keep reiterating monthly options. There are weekly options that have weekly expirations. So those are not what I'm talking about. These are the monthly options that expire on the third Friday of the month. All right, so our covered call this week is going to be on Aurora Cannabis, symbol A as in Alpha, C as in Charlie, B as in Bravo. The stock ended the week at $6.46 per share. I'm looking at buying stock and selling the May 7 call at 68 cents. That could give us a return of 18.89% in 4 weeks. Now you enter this trade by buying stock for $6.46 per share and selling the May 7 call at 68 cents. This trade makes the most money if stock prices finish above $7 per share. The break-even price is $5.78 per share, and in real terms, the stock purchase will require $646, and you'll collect $68 for selling the option. Next up, we have the credit spread on the United States Oil Fund ETF, symbol U as in uniform, S as in Sierra, O as in Oscar. The stock ended the week at $78.83 per share. I'm looking at selling the May 78-77 put spread at 34 cents, which could give us a maximum possible loss of 66 cents per spread. Now you enter this trade by selling the May 78 put at $1.86 and concurrently buying the May 77 put for $1.52. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $78 per share. The break-even price on this trade is $77.66 per share, and in real terms, you'll collect $34 per spread that you sell and have $66 at risk. And then our final trade on the week is going to be a debit spread, looking at Paramount Global Class B shares, symbol P as in Papa, A as in Alpha, R as in Romeo, A as in Alpha. The stock ended the week at $12.44 per share. I'm looking at buying the May 11-12 call spread for 63 cents, looking for a maximum gain of 37 cents, or that would be a 58.73% return in 4 weeks. Now you enter this trade by buying the May 11 call for $2.06 and concurrently selling the May 12 call at $1.43. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $12 per share. The break-even price is $11.63 per share, and in real terms, you'll pay $63 to enter this spread, and your maximum gain is $37 per spread. And this trade might actually be a tough one to get into as well because there's a buyout, there's a merger possibility. Two other studios have mentioned that they want to buy Paramount, and that's why the stock is showing some high volume because it typically hasn't shown as much. So that's it. There's going to be some opportunities in the options. As always, thank you guys so much for listening. Again, if you're interested in being part of that technical analysis workshop, shoot me an email and I'll send you the details. My email, of course, is eric@theweeklyoption.com, or you can just shoot me a note through the contact page on the website. So that's it. Hope you guys have a great weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.